What's going on, traders and creators? In today's video, we're going to cover how you could have caught over 100 pips on this USD CAD buy. So in this video, we're only going to cover it on the 15-minute time frame, but obviously in a real trade environment, when we're really trading this pair, we're going to look at way more time frames and analyze more of the direction and also precision on lower time frames. But for this example, it's going to be a quick little video of how you could have capitalized on this trade. So the first thing we want to look for are retail patterns, possible stop losses of where retail might put their stop losses. And the number one sign of that are double bottoms, double tops, places where indicators may have told them to buy or sell. Basically, these are just spots where you think or you know where retail stop losses might be. And I'm indicating in these zones that these are areas where pools of money from retail stop losses may be. So the reason I put them under here is because we have a strong support or a floor or a double bottom or a W, whatever retail traders might see this as. And then also right here we have a W pattern. So a lot of retail traders may be looking to buy in this area. And where do you think their stop losses are going to be? They're always going to be below the lows and above the highs. So now that we've marked out potential areas of where stop losses may be, we need to look for wicks that take out those stop losses. And as we can see, that is this area right here. We call that the FU candle. Reason being is because these candles or wicks are the ones that take out retail stop losses, in this case towards the buys. So now that we have our area of stop losses and the wicks or candles that take out those stop losses, now we have our area of entry. And the reason is because this is the candle that first takes out all those traders. So what we're going to do is go from the top of the wick to half of that body. Oh, that's my bad. So we're going to go from the top of this wick to half of the body and extend it out. And now this is our entry zone. And as we can see, the only entry we would have gotten is at the top of this wick, which is completely fine, but I'm just going to mark that out for you guys with this yellow circle. So basically this yellow circle indicates where we would have gotten into the market and basically where we want to put our stop loss. And it may seem a little contradictory, is below the lows. And the reason for that is because we already know that these lows have been swept by these candles. So there's really no liquidity under these lows, meaning there's no reason for big money or big banks to come past these lows one more time. So our stop losses should be safe under these lows or possibly these. Our stop loss is around 35 to 40 pips for this trade. And then when we're looking for our take profit areas, we're just going to do the same exact thing, but on the opposite side. Remember, as above, so below. So we're looking for potential areas where there might be stop losses of sellers. So we can see that this is a very big area where possible stop losses may be of sellers, and then also areas like this where we have equal highs and equal lows. So we could have taken this trade for, a good 1.5 to 1 risk reward ratio, stop loss 35 pips, take profit 50. But what we are really looking for is that nice long trade of over 100 pips. So that way we can get our risk to reward ratio above 3. And the reason for that is because we have this high right here, which you can tell there are going to be a lot of sellers and stop losses in this area. And as you can see, this trade played out beautifully. And in a matter of less than 12 hours for this whole trade to play out and minimal drawdown. So if you guys enjoyed this video, make sure you leave some love on the YouTube and Instagram. We really appreciate your support. And if you guys are enjoying these videos, let us know so we can keep making them. We'll see you in the next one.